Excellent. Okay. Good morning, everyone. My name is Ted Harris. I'm with the Pennsylvania Petroleum Association. I would like to thank you for joining us on our monthly webinar series. This normally happens the first Tuesday of every month at 9 a.m. Last month we got a little thrown off, but we're back on track here in May. So before we get started today, I would like to remind you that you are on mute as an attendee. So with that being said, we do encourage you to interact or ask questions. And the way that you can do that is by using the question feature and go to webinar. So you would type your question, and then after Dan's presentation today, I will moderate those questions to Dan. And for some reason we can't answer your question, or we don't get to it, or whatever the reason may be, I will connect you after the fact and make sure that you get some clarification on whatever you may ask. So at this point, I would like to introduce our speaker this morning. And we just a really quick background. We actually had this scheduled months ago for our May webinar, but the topic on payments, I just think with what have gone through in the last 8 weeks with COVID-19, and I think how that's going to change the way that we interact and do business in the future. I think it's a really perfect time to think about your current payment structure, your current payment strategy, and I'm sure Dan will do a really good job going over that here today. So with that being said, I would like to introduce Dan Rowe. Dan is the Vice President at BillingTree, and Dan will be covering creating a payment strategy that benefits your company and your customers. Dan, I'll pass it off to you.
Thanks, Ted. Appreciate the introduction, and thanks a lot for everybody jumping on the webinar today. I know Ted was mentioning the video is a little bit new for everybody, but it's new for me too. I'm trying to get into that comfort zone of being on these video conferences, because it's going to be, like Ted said, part of the new norm as we get used to things moving forward. So anyways, bear with me as I try to do this from home. This might be a dog barking or a kid tugging on my leg or something else, but I know we're all kind of dealing with some crazy stuff right now. And thanks, Ted and the PPA and everybody in the organization for allowing me to get up and speak about payments, hopefully give you some information that'll help maybe change the perspective on payments. A good strategy starts with information. So kind of just getting you in tune with some of the information around payments that'll be key. The cost, the expectations, the technology that's available out there. So I think if we can go through and run through some of the just key understandings that you're going to have to kind of change that perspective from payments being just a cost center to payments as a business tool, a value-added business tool that'll help you run your business more efficiently. And also the biggest part, I think, the takeaway here is customer experience. Hopefully there'll be a change in perspective on how we look at payments related to that customer experience as well, and how that impacts our business. So to just get started, a brief history in payments. Back in the days, it started with the seashell, and that was the form of commerce, or bartering. I guess they figured once they moved off the coast and into the interior, that wasn't going to be a viable solution. Not sure exactly whereabouts the seashell faded into obscurity, but soon thereafter, the paper check and the check in the mailbox for the fuel companies came along, and that seems to be the preferred method of payment for forever in fuel. And credit cards and online payments are definitely prevalent, and more of today's oil and propane companies are doing those things, but I think most still prefer that paper check in the mailbox. And I think that perception of credit cards being a cost center, perhaps not really understanding what the true cost of payments is compared to the true cost of a check and all the other intangibles that go along with it, may have been lost over time. So there may be a slow adoption of technology and maybe some payment technology in fuel and oil. But I think right now with the consumers where they're at, they want more digital payments. And I think a lot of companies are coming in line with it. So if we can go over some of the intangibles, like the cost that's associated with it, and kind of really give you an expectation on what that means across your entire receivables, you may look at credit cards not as just a cost center, but you might see those values and those benefits and worth the cost that comes with it. So the biggest thing is the shift in consumer trends, I think, that causes some of these changes that happens in payments. Cost of processing was prohibitive a while back. 10, 15 years ago, things changed. If you're part of, my computer's geeking out on me and popping something up there. I don't know if you can see that. Hopefully not. But long story short, over a decade ago, things changed where the industry wasn't viewed like every other industry. You guys were part of an evolution in the payments industry. So if you think back, I can remember a day where I couldn't go to a fast food place and use a credit card because the interchange cost that it would cost for them to take my credit card was less than the profit margin on a Big Mac. So long story short, similar to fuel, you guys were not accepting too many credit card payments. Check was prevalent, and that's because the cost of interchange was prohibitive. So when things are too high in cost, those values don't really get to see their full potential. So that changed. So that was big. We'll go over that a little bit in further detail. But what happened is billions of dollars have been saved since that change happened. So perhaps if we can see payments not being a cost center, but actually being really low costing compared to a lot of other industries, that could help change that perception on, the credit cards as a cost center. The adoption remains low. Over our portfolio, we see about 25% credit card market share for payments. So that means that the credit cards, they're still not being promoted. I think most companies kind of maybe try to shift people towards those paper checks because of the perceived value that doesn't cost anything extra to take it. So when done right, credit cards are a business tool and they should add tremendous value. So the way I like to liken it is, the credit card brands think you're special, along with the McDonald's that helped evolve their industry. They're able to pick up billions and billions of dollars in extra processing volume because instead of having their high interchange costs across the board for all types of industries, they have to basically take each industry and say, okay, where's the reasonable rate of percentage that we can charge here? What's the risk level associated with this type of transaction? When it comes to a fast food restaurant or an oil or energy dealer, it's a very low risk transaction because you're, in a fast food joint, you're right there, you're going to eat that burger, you're going to walk away. You're not going to call and say, I didn't get that burger that I never paid for or I shouldn't have paid for. In fuel, it's a homeowner, they're keeping their house warm. These are your neighbors, these people are in your community. Chances of them coming back and saying this transaction is not legitimate is very low. So therefore, the industry looks at you as being special because it's low risk. So therefore, they can offer some better pricing. And also, you're providing a essential service, as we all know now, but that's a utility for homeowners that they need. So it's not just a want, it's a need that these homeowners need to have. So therefore, the credit card companies came around and they adjusted their interchange costs. So interchange is basically what the card brand charges for each individual card that comes through. And there's thousands of different interchange categories. For example, if you take a MasterCard rewards card versus a MasterCard commercial card or a regular consumer card versus a debit card, each one of those has a different rate or fee associated with it. So when I say they look at you special, is they took all those individual rates and fees and they categorize them specifically for you. So MasterCard and Visa think of you a little bit differently. MasterCard and Discover actually grouped you into what they call the utility classification, which most of you may know already. Some of you may not. This is news for you. But either way, if it's basic, just bear with me, we'll get through it. But the utility classification gives you the ability to access the lowest possible percentage rates available in interchange. And that's, instead of a percentage rate of 2% or somewhere around there, it's a flat 65 cents, 75 cents, or $1.50, depending upon what type of MasterCard or Discover that is. So when we're dealing with an average transaction in this industry of around $375, that 65 cents compared to a percentage rate is a bargain, huge bargain. Visa, on the other hand, didn't quite agree that you guys fall in the utility category or didn't think you needed special attention or benefit, but they did tweak things a little bit for you so that you fall into what they call the emerging market category. no 65 cents, 75 cent, anything like that. The lowest possible rate you can see with your Visa credit cards is 1.43%. Get into that a little bit as well when we start going over the costs a little bit more. But that's great because the typical Visa card is, 2%, 2.5%, especially in a non-swiped environment, which most of these transactions will be. So in order to get you set up correctly, there's a secret sauce. And that secret sauce is making sure that you get the right classification for each card brand. And 4900 is the MCC, which is a merchant category code for MasterCard and Discover. And 5983 is what you would put for the merchant category code for Visa. Now, when you do that, everything's going where it should. All the transactions will qualify as long as other factors like right information is being passed. But for the most part, you're getting the best possible rate for each card brand. If it's not done this way, so for example, if let's say, for example, you're set up with a company, they said, oh, well, you're a utility, I'll set you up on a utility MCC. You do that, you get all the great rates on MasterCard and Discover. Fantastic, because that's the biggest benefit and the biggest, I guess, value is the MasterCard and Discovers. But what happens on your Visa cards is since they don't consider you a utility, when those transactions start coming through the Visa rails and it recognizes that, hey, this business didn't qualify and isn't registered as a utility, it bounces off that interchange category and downgrades, right? So those cost you more money. So therefore, when you think, oh, I got utility rates, that's great, you're getting the benefit there. But not only are you not getting the benefit on Visa because of that one merchant category code, you're actually paying more through a downgrade because you didn't have that second split merchant category code. So why is it secret sauce? Well, it's secret sauce because it's just not that well known, not only from a consumer perspective, like from a merchant perspective, you guys, a lot of folks don't realize it, but it's also not well known in the credit card industry. There's not too many scenarios where you'll have Visa looking at a business or an industry differently than you'll have MasterCard looking at an industry. And that's where that split comes in. So since those two look at you guys kind of uniquely as being different, and most everybody else falls into a round peg, or a round hole with a round peg, they can kind of treat them as a blanket. Your MCC fits across the board. So for a provider that doesn't necessarily specialize, one, they may not know that there's the ability to do a split merchant category code in a merchant account. And two, more importantly, not too many processors can do it. A lot of systems out there are only built to allow one merchant category code because there's really no conceivable need to have to do it for the most part. So that's wherein lies the value of a specialist like a Billingtree, or there's a handful of other specialists in the industry, which many of you probably use today. So not all providers are created equal. And this is not a sales pitch to say, hey, come with us because we're the best. But what it is, it's your local bank and your credit unions, they probably don't know how to set you up. Like I just mentioned, they're not going to realize that there's a special classification. And if they do, or if you tell them, they may not be able to add that second MCC. So when you think my community bank here is the best and they give me great rates and financing on my loans, and I've got all these different lines out with them, so they're going to be the best solution for this because they're going to bundle my payments in. Well, that's all great, and they probably do have the best intentions in mind. But what's going to happen is that low rate doesn't get realized because you're paying extra in all these interchange costs, and that's wiping out any benefit that local connection or whatever might have had. So not only can the local banks not set you up, but a lot of folks that I speak with have, their sisters, cousins, brothers, mother that sells payments. And, there's a lot of agents, individual contractors out there that sell payments for larger companies like us. But those folks aren't going to have the individual knowledge specific to your needs. And their companies that they sell for typically aren't going to coach them on that or know to. So having a friend or a family member is great in payments, but unless they know your industry, they're not going to be that helpful because they'll give you the best rate in the world, but then those interchange costs will stack up and it really won't be seen. So 1/3 of the accounts that we review basically end up not being set up correctly. Well, my screen's not switching like I had hoped. There we go. So 1/3 of the accounts that we look at, they're not set up to get these benefits. And there's a huge impact when it comes to cost. So it is something you definitely want to be aware of and make sure you're taking a look at to see where you stand with whether or not you're set up correctly with the proper categories for all card brands, not just one or the other. So how do you determine if you're set up correctly? There's several ways, but the first thing is pull out your statements. A lot of people don't seem to get paper statements anymore. Personally, if it's my business, I would say request paper statements along with the digital ones. But if you don't get a paper statement, there's a portal of some sort that the company's probably set you up with, required to, that's going to house all your statements and other reporting and other things that'll be beneficial to you. So if you don't get a statement in the mail and you don't know where to find them, you might want to make a phone call just to say, hey, what's my portal access? And that way you'll be able to get into your self-service portal and you can see, a bunch of things that are available for you in there. When you have your statements and you're looking them over, some statements will show the interchange categories listed out on them. And if that's the case, great. You just want to cruise down to that section of the of the statement, take a peek for the descriptors, and if you see utility in there, great. You probably have those utility benefits for you. You want to check Discover as well to make sure they match, because sometimes if it is set up split, maybe the Discover doesn't end up on the right category code. So the effective rate is a tool that you can basically use, and that tool is your cost divided by your total volume. So when you're trying to determine your effective rate, you're going to just take, okay, here's my statement. I paid this much money on my statement, and here's the total volume that I ran to get there. And that percentage rate is going to be your effective rate. That's what we call your effective rate. Some call it a blended rate. Any way you slice it, that's the overall percentage that you paid for credit cards in that specific month. So we'll go over what that should look like in a second. But when you're also looking at your statements, you want to kind of take a peek at your card mix. The card mix is going to be one of the biggest factors that plays into, where you are in that range of good, bad, or indifferent when it comes to your costs. Demographics play a huge part in card mix. Different parts of the country have different market shares of credit cards. More affluent areas will have more Amex. Less affluent areas will have an uptick in more debit card transactions. Michigan, for some strange reason, has a large market share of MasterCards, which is great for them because any fuel dealers in Michigan really pay like 1% based on that uptick in MasterCard. So yeah, the card mix will shift because based on what we see in a second here with the different costs per cards, what you get on the course of a month is really going to shift it. So each month, your effective rate that we just talked about will shift because the cards coming in every month aren't the same. And you're going to kind of land in a range each month where it's not going to be wildly different one month to the next, unless, of course, there's a new client that starts using a crazy business card or an Amex that shifted things one way or the other. But typically, you should be within a range and a not too varying range on effective rate. So when we're talking about that effective rate, you want to kind of be in the range of 1.25 to 1.75%. Now, I've thought about whether or not I should share this one because you can get in trouble if someone says, oh, you told me I get a 1.25 and I'm not, I'm getting a 1.6. So there's a lot of factors, like I mentioned, that go into this, but for a typical fuel oil home comfort dealer, you should expect yourself to be in the 1.25 to 1.75% range. That's basically on a $375 ticket, anywhere from, say, $4.69 on the lower end to $6.56 on the higher end. All right, so let's set some perspective around that. Each transaction taken on a credit card is going to vary. Your Amex is going to cost more than that. Your debit cards are going to cost less than that. But in the middle range, overall, you should be somewhere in that 1.25 to 1.75 range. So the factors going in, like I said, the card mix, the demographics, are the MCCs passed correctly? In your gateway, you need to pass certain information along with that transaction if it's not swiped through the terminal, and that information that's being passed also determines what type of interchange you see and will affect your effective rate. So lots of different factors that go into that. But when you think about $4.69 to take a $375 order, that's the type of perspective you want to start thinking about. Okay, so here's my cost. Well, obviously figure out your effective rate specifically, but then say, here's my cost. Over the course of my entire receivables, it's X percentage of cost. And then you can really say, okay, so this is the true cost. This is what credit cards, this is the pain credit cards is inflicting on me. How much money, how much pain. But for that pain, how much value and benefit am I getting? Which there's plenty, and there's more slides on that, like faster cash flow. But before we get into that, just kind of to build up the expectations around costs and how you set your strategy, MasterCard and Discover are going to be your cheapest. You know, they're going to be around 0.5%, which is pretty crazy when you think about credit card acceptance. If the only card you ever took was MasterCard, you'd be processing fees around 0.5%. So that's pretty spectacular and definitely a benefit that you want to highlight. Don't waste that. And people don't get it, they don't realize it or understand it, but once you raise awareness about it, perhaps that'll help shift folks' payer behavior. But I think you should set your own preferred payment methods around, you know, this type of information here that says MasterCard's going to cost you a lot less than if you go, you know, and take an American Express or a Visa card. So how do you handle that information? What do you do with it to help your business? Perhaps instead of discounting someone for a check in the mailbox at the time of delivery, perhaps you discount someone for putting a MasterCard on file for autopay. And then in that case, you know you're going to get the best utility rate possible. You've got your preferred method of payment in there for them, and you've persuaded them to be thoughtful about their payments. Like, I could give you my Visa or my Amex or my MasterCard. I don't care. I'm collecting points on all of them. But if you tell me and I like your business, I'm going to do right by you and say, oh, cool. All right, I'll give you a MasterCard. So perhaps there's something you can do to shift payer behavior into one of these lower costing solutions. Debit cards on here looks a little bit lower, so you might say, why wouldn't I want to shift everybody to debit cards? And you know, for certain areas, I'd say, yeah, do it, because that's what's prevalent in that neighborhood, and debit cards can be great. But typically, the size of a drop of fuel at a tank is going to be less on a debit card. You might get an order for 100 gallons versus 175 or 150 or whatever a full tank would be. So partial drops on debit cards are more frequent. So that's why I would say, even though it's a little bit less money, you know, paying less probably doesn't bring the added value that a MasterCard or a Discover would, because you're likely to get a bigger order. So when it's done right, fuel payments will add value. Maybe you didn't know MasterCard was extremely cheap compared to Visa and Amex. If so, perhaps that's something that can kind of shift what we're thinking about here. You know, should you take Amex? I believe you should. Maybe you don't advertise it, but there are going to be those situations where you have a business customer or a high profile customer that wants to use their Amex, and you don't want to lose that sale or that customer. So perhaps you have it in your back pocket and just offer it when the time seems fit, but not advertise it on the door or in your advertisements or marketing pieces. It says it, because then you may have people that jump on the Amex bandwagon just to start raking up those points where they maybe didn't expect you to take that card in the first place. All right. So the three things that I think are key here is going to be, keep trying to change it with that. If done right, we should have an increased cash flow, a better customer experience, and we should be delivering larger orders if our payment strategy is in line with the value that it does bring. So now that we have a handle on the true costs of credit cards, the emerging markets, the interchange benefits that are available, you kind of see the perspective of the homeowner shifting. You've got younger families moving in. Those millennials want a different type of payment experience. So, you know, create that payment strategy and see the positive impacts in the following areas: faster funding, easier reconciliation, detailed reporting. You can do alternative payment schedules for different types of customers that may have different needs. The recurring payments aspect of it. Long story short, when you give people more options to pay, it'll be easier to pay you. But if you give them the payment methods that they're familiar with or more inclined, you're going to improve that customer experience. So not only does the fuel come seamlessly and the customer experience when they call on the phone is great and the service techs are all fantastic, making a payment with you guys is super easy. So that's something that I think is key that not a lot of people think of when they're thinking about payments. What's the customer's perspective on all of this? So payment processing is a business tool similar to routing software. Excuse me. Your back-end solution or a good conferencing service like this, which is key in these days. And then all these services have fees associated with them. And these services should add more value and make running your business easier, and more efficient. So I don't know if so far what we've talked about has helped shift anybody's perception. But that's kind of the goal here, is to realize that it's not really that expensive when you think about it. You can build that into your pricing when you think about it across what's that actual cost, not only per delivery, but per gallon of fuel sold. Can I add a penny here or there to pick up that cost and then really not even see the impact of the small credit card fees that are coming through? So a couple different ways to think about it. But that payment strategy should be a three-pronged approach, which has customer wants addressed. The customer wants are going to be simple, easy, convenient. They want to earn credit card points, and they want to buy it now and pay for it later, typically within the month, so they're not carrying over interest fees and whatnot. But it's just the preferred method of pretty much every younger adult in this country right now. So when we see 25% of the payments coming in, there's a disconnect between the number of payments coming in and what the consumer trends are saying. The second one needs to be your office needs. So there's folks inside the office that manage and handle these payments on a day-to-day basis. So you obviously want to make sure that there's detailed reporting, easy reconciliation, and you want to eliminate as many manual steps as possible. From a business perspective, you want to improve efficiencies, which is going to be less time chasing those payments, faster time to cash, and then automating customer payment schedules. This is all time-saving stuff that will add efficiencies through some of these simple payment technologies that many of you already have access to. And some of these things don't cost anything extra to utilize. So ask yourself some questions during your strategy research. Are you taking advantage of integrated payments? You've got a back-end software most likely, whether it's Ads, Gargus, Blue Cow, RCC, or one of the others. Are you taking advantage of those integrated options? Because that'll definitely be a huge time saver for anybody in the office side of things. Should you take electronic checks? Probably. Do you have a refund policy? If you don't, you should. Even if your policy is no refunds, just state it somewhere so it's known. Do you offer discounts on check payments? We talked about that briefly. I don't recommend it, but it's your strategy, what makes the most sense for your business. Should you charge a convenience fee? This is a kind of a hot topic lately, and I don't think so. There's lots of rules and regulations around surcharging, a little less around convenience fees, but they really are a horse of another color. So I would be careful with convenience fees. It could upset your customers, and personally, if you're going to make MasterCard a preferred method of payment, I wouldn't persuade anybody from making that preferred method of payment by adding a fee to do so. And there's restrictions around adding any convenience fees or surcharging to debit. So you do want to be careful, because a lot of times if you have the ability to add a convenience fee through your gateway or software, it's not going to have the ability to decipher whether it's a debit or a credit card, and therefore you could be opening yourself up to a complaint. How do you secure a payment when you don't know the final price? Are you using pre-authorizations? Are those pre-authorizations costing you more money? Is it holding funds available or unavailable on customers' accounts longer than they need to? They could be. So that's something you just want to kind of analyze and see, what are my options for either pre-authorization, releasing those pre-auths, or doing refunds and credits. Can you take payments on your website? Definitely something a lot of consumers are looking for. And then how will you promote your preferred method of payment? How do you get the word out that, if you're going to make a payment, I'm going to make it easy for you, but this is what I would prefer you to pay me with. And what card brand should you accept? So the Visa, MasterCard, Amex, I would recommend take them all. Features and functionality, these are all things that you can add to your current situation or solution to kind of make that customer experience better, add multiple cards on file, recurring billing, budget payments. There's tools like Account Updater. So if you've got an expired list of credit cards in your system, this system will actually go out and update those cards for you without the manual effort of making a phone call, getting a new card, and all that other headache that goes along with that. So level 2 pricing, level 3, these are all fantastic things that most folks aren't taking advantage of. A lot of these features and functionalities live in your gateway and some in your integrated software. So if you're using authorized.net or NMI, some of these may not be available to you. And if you're using authorized.net or NMI, some of these may be available, but just not in an integrated fashion through your third party, backend software, whoever you're using. So there's a couple things you got to kind of work with here to figure out, well, what features and benefits are actually available with the solutions that I have at hand. Let's see here. So this has gone a little bit longer than I've expected, so that's good. I think not too long, hopefully, but the future of payments, you got to address the millennials and the generational trend shifting. You know, it's a matter of, you want to be where your customers are. You want to give your customers that experience that makes them say, I love working with this business. So you definitely want to be in tune with how payments is affecting those homeowners and those younger families moving into those neighborhoods that you're servicing. Technology, check your technology, see what you've got in play, because you want to make sure you've got the ability to shift and adapt with any changes that are coming down the road, as there are many. Changes to interchange, pretty much biannually, the card brands are looking at those interchange fees we mentioned, and they're making adjustments. They don't typically affect the entire interchange categories across the board, so we don't usually see too many hiccups or increases there, but there have been a few recently that have affected energy. And if you're not working with a specialized provider, like one of the few we talked about, there's a small handful in the industry that focus on home heating and energy payments. They'll share that information with you so you're aware. If you're with one of those providers that doesn't know it, you'll never know it. And you may not even be getting those benefits that you're missing out on anyways. Security and PCI is ever changing, so you want to make sure the company you're with and the software you're using is going to help you make sure you're maintaining those security levels. And then, not to kind of keep beating that dead horse of what we're all going through here, but the COVID-19 pandemic has definitely made an impact on society while we're all kind of still shut in. I can't wait to see what it looks like when we're all out. So I think things will be different. You probably do too. But I think this is probably the real shift to touchless payments. It's been coming for a while. Adoption's been slow. Apple Pay, you know, NFC, all these types of things have been around for a few years now. But this is probably going to be the thing that kicks all that adoption into high gear. So I would say, as part of my marketing practices, obviously, as we're all trying to market to our customers and whatnot, to, you know, wish them well, health and safety, but we want to also let them know what we're doing to prepare our company to prepare for the new society that emerges out of this craziness. So with that being said, use your payment technology to promote a touchless environment, giving your customers that sense of security that you're taking things seriously and all that jazz that goes along with it. So I hope this was at least a little food for thought, give you some background knowledge on the things that are important to kind of developing your strategy. I may not have spelled out a strategy for you to take from here and move with, but every business is different. So you're going to have to kind of work within your parameters, your marketplace, your company, and figure out what strategy makes the best sense for you. And I'd be more than happy to help, or just call your provider and see what they have to say. But I'm open for any questions, comments, or feedback. I don't know if Ted's fielded any questions in the during the duration of this, but if so, feel free to send them my way.
Thank you, Dan. Just a reminder, you can ask questions by typing them in the question feature and go to webinar. You know, Dan, we'll give it a couple seconds here to see if anything comes in, but just to echo your comments there at the end, I really think, you know, we're already starting to see some of our members and other contractors across the state move to no contact, you know, interactions with the customer. And, you know, obviously handing off a check or handing off money is, you know, defeats that purpose. So I can't emphasize enough. I think you're going to see more and more adaptation to to going that route. So
I think you're right.
we do have one question that
Sure.
came in. This is an easy one. Will the slides be available? Yes. Dan shared them with me prior to the presentation, and I will send you a copy, the individual that just requested that. If anyone else on this webinar wants to get a copy, please email me, or Dan's information is also on the screen here. But yeah, we can absolutely share a copy with you. And then anyone that attended this webinar will get you'll get a link sent tomorrow morning to have a replay where you can go back and watch this at a later date if you would like to do so, or share it with anyone within your organization. So see if we got anything else. Okay, that was easy. Dan, thank you so much. Appreciate it. Appreciate your time. Appreciate your expertise. Thank you everyone for joining us this morning. Just a quick reminder before we sign off here, we will have our next scheduled webinar June 2nd, and that's going to be with Angus Finance, talking about financial considerations for the warm winter. And I'm sure we'll also have some other information in there in regards to COVID-19 and just how that's impacting our membership. So Dan, with that being said, anything you want to share before we sign off here?
Well, it sounds like you get another great topic coming up next. I really hope that I get to see all you guys at Triple E in August. Wishful thinking, I think, at this point. Yeah, I miss out on all the trade show interactions and the nurturing of these relationships. So thank you for joining in. Many of you may know me. If you do, reach out and say hi. If you don't, I'd love to chat with you, and perhaps we'll meet in the future as we regain some normalcy. Thanks a lot, Ted and PPA. I really appreciate it, and everybody stay healthy and safe.
Okay, thanks a lot, Dan. Have a good day, everyone. Take care.
Bye-bye.